In the damp autumn of 1890, the undisputed financial capital of the world faced a sudden, terrifying systemic crisis that threatened to crush international trade and dismantle global markets. At the absolute epicenter of this impending economic disaster stood Baring Brothers and Company, one of the oldest, wealthiest, and most prestigious merchant banking houses in Great Britain. For over a century, Baring Brothers had underwritten sovereign governments across continents, funded transcontinental railways, and financed global maritime trade, building an international financial reputation so vast that European statesmen famously claimed there were six great powers: Great Britain, France, Russia, Austria, Prussia, and Baring Brothers. Yet within a few frantic months, reckless sovereign debt underwriting, speculative real estate manias, and political violent revolution in South America combined to push this legendary financial firm into hidden, catastrophic insolvency. Had Baring Brothers been allowed to fail openly in November 1890, its collapse would have triggered an immediate chain reaction of bank runs across London, bankrupting major commercial houses and plunging the entire global economy into a prolonged depression. The story of the Baring crisis remains the definitive historical case study of how emerging market sovereign debt default nearly destroyed Victorian high finance, forcing central bankers to pioneer the modern framework of systemic financial bailouts. To understand how a centuries-old London bank imperiled global financial stability, one must examine the frantic speculative investment boom that gripped South America during the late 1880s. Following decades of civil war, regional instability, and constitutional conflict, Argentina emerged in the late 19th century as one of the fastest-growing agricultural export economies on Earth. Global demand for Argentine beef, grain, wheat, and raw wool expanded rapidly, propelled by modern steamship routes, agricultural machinery, and mechanical refrigeration technologies that linked South American ranches to European urban markets. Seeking to modernize national infrastructure and project regional power, the Argentine government under President Miguel Juárez Celman launched colossal capital development programs, constructing thousands of miles of railroad tracks, deep-water ocean ports, municipal waterworks, and public buildings. To fund these ambitious national development projects, Argentine state authorities, provincial governments, and municipal agencies turned to European capital markets, issuing hundreds of millions of pounds sterling in high-yield sovereign bonds. London investors, eager for higher investment returns during an extended era of low domestic British interest rates, enthusiastically poured capital into Argentine securities, viewing the country as an unstoppable economic juggernaut. Positioning itself as the premier financial bridge between European capital wealth and South American economic expansion, Baring Brothers aggressively underwrote Argentine sovereign bonds, provincial mortgages, and municipal infrastructure loans. Under the forceful leadership of senior partner Edward Charles Baring, known historically as Lord Revelstoke, the merchant bank placed its immense institutional prestige and capital reserves behind securing Argentine bond flotations across European money markets. However, behind the glittering facade of rapid Argentine economic growth, dangerous fiscal, monetary, and structural imbalances were rapidly worsening throughout the country. The Argentine government financed its expanding public deficits by recklessly printing unbacked paper currency, triggering severe domestic currency depreciation and rapid price inflation across the national economy. Speculators used inflated paper pesos to buy up vast tracts of rural farmland and urban real estate, driving a massive property bubble that bore no realistic relationship to underlying agricultural productivity. Furthermore, widespread political corruption, fiscal mismanagement, and administrative inefficiency meant that vast sums of borrowed European capital were squandered on unproductive projects and political patronage networks. By 1889, foreign financial analysts and cautious economists began realizing that Argentina's external debt service obligations far exceeded the country's actual export earnings in physical gold coin. Alarmed by runaway inflation, rising trade deficits, and fiscal insolvency, London money markets cooled dramatically, and investor appetite for new South American bond issues began to evaporate rapidly. The critical turning point occurred when Baring Brothers attempted to underwrite a massive $25 million public loan for the Buenos Aires Water Supply and Drainage Company. Despite heavy promotional efforts led personally by Lord Revelstoke, British institutional investors flatly refused to purchase the newly issued Waterworks bonds, leaving the underwriting syndicate completely stranded with unsold debt inventory. Rather than canceling the loan contract and suffering severe reputational damage in the City of London, Baring Brothers made the fatal strategic error of absorbing the unsold bonds directly onto its own balance sheet, using short-term capital reserves to fund long-term illiquid assets. To maintain daily operational liquidity, Baring borrowed heavily from short-term London money market lenders, offering depreciating Argentine paper securities as financial collateral. In July 1890, political frustration in Buenos Aires exploded into open military conflict during the bloody revolution of the park. Armed insurgents fought government troops in the streets of the capital city, forcing President Juarez Selman to resign from office in complete political disgrace. The political collapse paralyzed Argentine national finances, rendering the government entirely incapable of meeting its scheduled interest payments on international bonds. In late 1890, Argentina officially declared a debt moratorium, defaulting on its international obligations and sending shockwaves of panic through European banking institutions. With Argentine securities collapsing in market value to pennies on the dollar, Baring Brothers found itself holding millions of pounds in completely illiquid, unmarketable debt assets. Worse still, short-term money market lenders refused to roll over Baring's maturing obligations, demanding immediate cash settlement in physical gold sterling coins. By early November 1890, Lord Revelstoke confronted a terrifying reality. Baring Brothers was entirely out of liquid cash and faced immediate default on its upcoming balance sheet commitments. On November 8, 1890, Lord Revelstoke quietly walked into the Bank of England to inform the governor, William Litterdale, that Baring Brothers required urgent financial assistance to survive the coming week. Governor Litterdale immediately recognized the existential magnitude of the threat facing the British financial system, the City of London, and the international gold standard. Baring Brothers held over £4 million in short-term bills of exchange accepted from merchants across the entire globe. If Baring defaulted, those bills would instantly become worthless paper. Commercial banks holding Baring's paper would suffer immediate liquidity shocks, sparking an uncontrollable, violent bank run across commercial banking houses in London. Furthermore, foreign central banks holding sterling reserves would rush to convert their paper pounds into physical gold bullion, draining the Bank of England's vaults and destroying the gold standard. Recognizing that public panic had to be avoided at all costs, Governor Litterdale executed a brilliant masterclass in financial crisis management. First, Litterdale secretively arranged to borrow £3 million in physical gold coin from the Bank of France to fortify the Bank of England's bullion reserves. Simultaneously, Litterdale negotiated with the Russian imperial government, securing a firm commitment that Russia would not withdraw its £1.5 million in deposit funds from London banks. Next, Litterdale summoned the senior partners of London's major private merchant banks, commercial banks, and financial houses to an emergency weekend meeting inside the Bank of England. Litterdale presented a stern, unyielding ultimatum. The British banking community had to collectively fund a private guarantee fund to cover Baring's liabilities or face systemic economic destruction together. Led by Lord Rothschild, who personally pledged £1 million sterling, the assembled bankers established a £17 million guarantee fund within 24 hours, backed by the Bank of England. This unprecedented private-public bailout scheme guaranteed all outstanding Baring obligations, preventing a general market panic and allowing Baring's illiquid assets to be liquidated gradually over several years. While the prompt creation of a guarantee fund successfully averted an immediate banking collapse in London, the broader global economic fallout was severe and prolonged across continents. The sudden withdrawal of British investment capital from Latin America triggered devastating financial depressions across Argentina, Uruguay, and Brazil, leading to widespread political instability throughout the decade. In London, Baring Brothers was forcibly restructured, bringing an end to its historic era as an unrestricted private partnership and converting the firm into a strictly regulated limited liability corporation. Lord Revelstoke was stripped of executive authority, and the Baring family surrendered much of their personal fortune to settle the firm's lingering financial liabilities. Recognizing his legendary leadership during the emergency, the City of London awarded Governor William Lidderdale the honorary Freedom of the City for preventing global economic collapse. By 1895, Baring's assets had been orderly liquidated, allowing the guarantee fund to be dissolved without costing British taxpayers or private banks a single penny. From a historical perspective, the Baring crisis of 1890 permanently transformed modern central banking doctrine and financial crisis regulation. It established the clear historical precedent that central banks must serve as systemic lenders of last resort, organizing collective intervention to contain financial contagion during acute liquidity panics. This pivotal historical event proved that in a deeply interconnected global financial system, sovereign credit shocks in emerging markets can directly threaten the core institutions of major financial capitals thousands of miles away. As with all economic and financial history content on this channel, this analysis is provided strictly for educational purposes and does not constitute investment or financial advice. Understanding the structural mechanics of the Baring crisis offers timeless insights into the dangers of yield chasing, illiquid leverage, and sovereign default risk. By studying how Victorian financiers managed systemic collapse, we gain essential perspective on the complex mechanisms used to maintain global financial stability today. The enduring legacy of 1890 serves as a powerful reminder that when sovereign debt bubbles burst, even the most prestigious banking institutions can fall to sudden illiquidity. The lessons learned during the Victorian bailout laid the foundation for modern central bank intervention mechanisms used during 21st century financial panics. Every major financial crisis in modern history echoes the fundamental tensions between sovereign borrowing, private risk-taking, and systemic contagion. Recognizing the early warning signs of credit expansion and asset price inflation remains one of the most vital tasks for economic historians and financial analysts alike. By studying the past, we equip ourselves to navigate the intricate financial networks that shape the modern global economy. The intervention engineered by William Lidderdale demonstrated that timely liquidity support can prevent localized credit distress from cascading into global economic collapse. Financial markets depend fundamentally on institutional trust, and when that trust falters, central bank leadership becomes indispensable to preserving monetary order. The historical balance between moral hazard and systemic preservation remains a central debate in modern economic policy. Modern financial regulatory frameworks continue to grapple with the exact same dilemmas faced by Victorian central bankers over a century ago. When financial institutions become too deeply interconnected with global trade, their solvency becomes a matter of public economic security. Ultimately, the events of 1890 demonstrate that financial resilience requires vigilant risk management, transparent balance sheets, and decisive leadership during times of crisis. By examining these historical episodes, investors and policymakers gain valuable context for assessing